In an era of, constant digital disruption, algorithmic advice, and this relentless fee compression, how can a 130-year-old financial institution, one built on that very foundation of human advisors, not only survive but actually thrive? Or, is its current share price already reflecting all of its impressive qualities, leaving maybe little room for new investors? We're about to embark on a deep dive to determine if Ameriprise Financial is a fortress of value, or perhaps a relic facing an inevitable decline. Welcome back to the Deep Dive, where we take your sources and really extract the most important nuggets of knowledge. Today, our mission is to dissect Ameriprise Financial, Inc., ticker symbol AMP, trading on the New York Stock Exchange. Our analysis is based on data as of June 22, 2025, with a reference share price of $510.35. We got quite a bit to unpack, so let's jump right in.
Okay, so we'll start by laying the groundwork, exploring what Ameriprise actually does, how it's managed, and the raw financial numbers. Business analysis.
All right, so let's get a clear picture of Ameriprise Financial first. They operate a pretty diversified financial services model. It's primarily through three main segments: advice and wealth management, they call it A&WM. Then there's asset management, and finally retirement and protection solutions. This integrated approach, it lets them serve clients across their entire financial journey, from early career right through to retirement. It builds resilience into their business model.
That makes sense. But how do they actually, bring in the cash? What are their key revenue engines?
Well, their income streams are quite diverse, actually. You've got management and financial advice fees. Those are stable and recurring, tied directly to the assets they manage for clients. Then there are distribution fees from selling various financial products. They also earn net investment income that's basically spread revenue from client cash, which, like most banks, makes it sensitive to interest rate changes. And finally, premiums, policy, and contract charges. Those come in from their insurance and annuities, primarily under the RiverSource brand.
Okay, so out of all that, what's really the core engine, like the powerhouse of this business?
The advice and wealth management, the A&WM segment, is absolutely crucial. It's their primary growth channel and client acquisition channel, too. It contributes around 65% of their total earnings. Think of it like a powerful flywheel. They have over 10,000 financial advisors who build these deep, trusted relationships with clients. This trust then makes it easier to cross-sell their own proprietary products, like Columbia Threadneedle mutual funds or RiverSource annuities. And this integration isn't just, nice to have, it dramatically boosts client retention. Get this, clients who own even one RiverSource product show 3.2 times better retention rates than others. That's some serious stickiness.
Wow, 3.2 times better retention. That's huge lever for client stickiness, isn't it? Does Ameriprise actively incentivize advisors to cross-sell these proprietary products? How much of their strategy really hinges on that integration?
Oh, it's absolutely central to their strategy. The integrated platform is designed to make it easier for advisors to offer a comprehensive suite. They offer a full range of services, everything from the Ameriprise Financial Planning Service itself to IRAs, access to over, 2,100 mutual funds, individual stocks, even alternative investments. Globally, their Columbia Threadneedle Investments arm handles the asset management part, and RiverSource provides life, disability, and long-term care insurance, plus annuities. They even have Ameriprise Bank, FSB, for banking and cash management. This whole holistic approach is what they believe sets them apart. They target affluent households, with $500,000 to $5 million in investable assets, what they call the responsible mindset consumer.
Okay, that paints a pretty clear picture of their offerings, but how big a player are they in the vast financial market?
Well, they're certainly not small. As of early 2025, they managed, administered, and advised on over $1.5 trillion in assets, serving more than 2 million clients. This positions them as the 24th largest global asset manager and a top 10 provider of variable annuities in the U.S. And that 10,000-plus advisor network is one of the largest in the entire industry. Here's a striking point, though. Since spinning off from American Express back in 2005, Ameriprise stock has delivered the #1 total shareholder return within the S&P 500 Financials Index.
#1? Wow.
Yeah, that's a truly remarkable track record of long-term value creation.
That is a significant achievement. Shifting gears a bit to the broader industry, what are the big trends defining financial services in 2025? And how does Ameriprise fit into that evolving landscape?
We're seeing a kind of dual dynamic. On one hand, there's accelerated AI adoption for efficiency and personalization. And then there's this persistent fee compression, particularly in asset management, as clients increasingly gravitate towards lower-cost passive investment options. Ameriprise's own asset management segment has, in fact, seen net outflows because of this.
So digital and passive pressure on one side, but is there a counter trend, something that maybe favors Ameriprise's model?
Absolutely. The other really powerful trend is the growing demand for holistic, human-led financial advice. As the U.S. population ages and wealth concentrates, financial needs just get more complex, and that drives demand directly into Ameriprise's sweet spot. They're investing heavily in technology, like their proprietary practice tech platform, but crucially, this is to enhance advisor productivity, not replace the human element.
Right, enhance, not replace. That makes sense. Who are their main rivals then in this intense competitive arena?
Oh, it's a fiercely competitive and fragmented industry. They contend with global asset management giants like BlackRock and State Street, integrated investment banks such as Morgan Stanley, independent broker-dealers like LPL Financial, and of course the discount brokerages and fintech disruptors like Charles Schwab. Ameriprise, with its market cap around $48.6 billion, is a significant player, but it's still smaller than the absolute giants like BlackRock or Morgan Stanley. The battle for affluent clients and top advisor talent is, without a doubt, intense.
Yeah, our sources highlight that intense competition, but also some interesting peer comparisons. For instance, Ameriprise has a trailing PE of about 17.4, while Schwab is higher at 24.5 and Morgan Stanley lower at 14.5. Yet their return on equity is remarkably high at 58.1%, contrasting sharply with BlackRock's 15.7% or Morgan Stanley's 13.8%.
Yeah.
So while maybe not the largest, they're clearly performing really well on some key profitability metrics.
And we absolutely can't forget the regulatory environment. It's a monumental factor in this space.
That's a great point. This is arguably one of the most heavily regulated industries globally, right?
Indeed. Ameriprise navigates this complex web of regulations from the SEC, FINRA, the Federal Reserve, the CFPB, you name it. Compliance is a continuous and substantial operational expense, and it effectively acts as a significant barrier to entry for any new players trying to get in. While there's always talk of, ease regulations depending on the political climate, the risk of new stringent rules always remains. Ameriprise's long history and sheer scale provide a robust compliance infrastructure, which is a definite competitive advantage for them.
Okay, speaking of those barriers, what truly stops new firms from just, popping up and directly competing with a player like Ameriprise?
The hurdles are pretty formidable. First, you've got immense regulatory compliance costs and complexity. It's just huge. Second, you need significant capital requirements to operate at this kind of scale. Third, it takes decades, literally decades, to build a trusted brand and reputation like Ameriprise's. Fourth, the need for massive scale and continuous technology investment is enormous. And perhaps most importantly, it's incredibly difficult and expensive to recruit and retain a large, highly productive advisor network. These factors combined really create a very wide economic moat around their business.
Okay, so with those formidable barriers, let's zoom in on their specific competitive advantages. How has their brand become such a durable asset over time?
Well, Ameriprise's brand strength is really rooted in its 130-year legacy. They've successfully navigated major crises from the Great Depression all the way to the 2008 global financial crisis. And crucially, back in 2008, they confidently turned down approximately $2.5 billion in government bailout funds from TARP, citing their strong capital position. That was huge. They even lent clients $700 million of their own corporate cash when money market funds froze up. This wasn't just a financial decision, it was a pivotal brand-defining action. It cemented their reputation for financial strength and integrity. That history, plus recent recognition as one of the most recommended wealth managers, builds immense trust with clients.
And that scale you mentioned, the $1.5 trillion in assets, does that translate into meaningful cost advantages for them?
Absolutely. Managing that kind of volume lets them spread substantial fixed costs. Things like technology, compliance, marketing over a huge revenue base. This leads to lower per-unit operating costs. It's a classic scale advantage. For example, they've invested over $1 billion in technology just over the last 5 years on their practice tech platform alone. This creates a virtuous cycle. Better tech attracts better advisors who then attract more assets, which further enhances their scale and cost efficiency. It feeds itself.
Right. Beyond cost, are there network effects or maybe switching costs that make it hard for clients to actually leave Ameriprise?
Yes, there are powerful forces at play there too. A network effect exists within their advisor base. Success attracts more top talent. For clients, the switching costs are significant, both, tangible and intangible. While physically moving assets might seem straightforward on paper, severing a deep, long-term, trusted advisory relationship is a major emotional and psychological hurdle for people. And the stickiness is truly magnified when clients use their integrated products. Remember that 3.2 times higher retention rate for clients with RiverSource products. That's a direct result of this integration.
So it's not just one thing then. What would you say are Ameriprise's most unique, maybe synergistic assets or capabilities?
It's precisely that synergistic combination. You have three core components working together seamlessly. First, a large branded network of over 10,000 highly productive advisors with that remarkable 92% retention rate. That's huge. Second, an integrated platform of proprietary financial products, Columbia Threadneedle, RiverSource, Ameriprise Bank. And third, a robust modern technology stack, that practice tech system. Few competitors integrate all three components so effectively into what they call the Ameriprise client experience. This integration, I think, is the fundamental enduring source of their competitive advantage.
Management evaluation.
We've painted a really clear picture of Ameriprise's core business and its strong market position. But, even the strongest business model needs skilled hands at the wheel. So let's shift our focus now to the leadership team, especially how they've performed under pressure.
Right. The company has certainly benefited from exceptional leadership stability. Chairman and CEO James M. Cracchiolo has been at the helm since the 2005 spinoff, and he led the predecessor firm for years before that, bringing over 45 years of experience. His leadership was profoundly tested during the 2008 global financial crisis. And what really stands out to me is how he confidentially turned down that $2.5 billion in government bailout funds from TARP, citing their strong capital. Beyond that, they even lent clients $700 million of their own corporate cash when money market funds froze. This wasn't just, a good financial move. It was a pivotal, brand-defining action. It built immense goodwill and trust with both clients and the market.
That's a powerful story of integrity and prudence, especially during a crisis like that.
Yeah.
How transparent are they generally in their communication, and what's their overall ethical reputation like?
Well, they maintain a high standard of communication with pretty comprehensive investor relations materials. Their stated core value is integrity always, and they've consistently been recognized for their highly trusted reputation. Now, it's worth noting, CEO Cracchiolo's 2024 total direct compensation was nearly $29 million. That's a 210-to-1 pay ratio compared to the median employee.
Yeah.
However, the company justifies this by linking it directly to performance. They cite his exemplary leadership and the company's status as the top-performing S&P 500 financial stock since 2005. So from a shareholder's perspective, you could argue this pay structure seems very much aligned with the value he's delivered over the long term.
Okay, let's delve into how this leadership team actually allocates capital. Where do they invest the company's money, and what's their strategy when it comes to M&A acquisitions?
Management has a very clear and consistent capital allocation strategy. It consistently prioritizes shareholder returns while still investing for future growth. They've invested over $6 billion back into the firm since 2005, with a heavy emphasis on those technology platforms like Practice Techie. Their M&A strategy seems disciplined, like the 2010 acquisition of Columbia Management, which significantly scaled their asset management segment. But the primary use of their substantial free cash flow has consistently been direct returns to shareholders.
And how do those shareholder returns actually manifest? Specifically, can you tell us about their share buyback history and their dividend policy?
Right. Their capital return program is both aggressive and remarkably consistent. They are a voracious buyer of their own stock. Just in April 2025, they authorized a new $4.5 billion share repurchase program through June 2027. And in Q1 2025 alone, they returned $765 million to shareholders. That represented a massive 81% of adjusted operating earnings for the quarter.
81%.
Yeah. This consistent reduction in shares outstanding is a powerful driver of their earnings per share growth, and their dividend record is exemplary. They boast 18 consecutive years of increases and a compound annual growth rate of nearly 10% over the last decade. Most recently, an 8% increase to $1.60 per share was announced in April 2025. And this robust growth is supported by a very conservative payout ratio of just 22%. That means the dividend is incredibly safe and has substantial room for continued future growth.
That sounds like a powerful signal to shareholders, doesn't it? On the flip side, how efficiently does Ameriprise generate returns on the capital it actually uses? When we look at return on invested capital, or ROIC, what does that tell us?
Their ability to generate returns on capital is truly exceptional. They report an adjusted operating return on equity, ROE, of 52.7% for 2024 and 52.0% for Q1 2025.
And for listeners who might not be crunching these numbers daily, what's the plain language takeaway there?
Right. So in simple terms, ROE tells you how much profit a company makes from each dollar shareholders have invested. And ROE like that is incredibly high. Now, while some of this is leveraged, their underlying profitability is confirmed by an excellent return on invested capital, ROIC, consistently between 26.3% and 30%. ROIC tells you how good a company is at turning the money it invests in its business into operating profit. So for every dollar Ameriprise puts to work, it's generating 26 to 30 cents in annual operating profit. That's considered world-class efficiency. It means they're generating serious returns from their operations. Such high returns are typically only sustainable by companies with really durable competitive advantages.
Financial analysis.
All right, that brings us to the nitty-gritty of the financials. Let's dive into their scale, cash flow, and how the market is valuing them right now.
Okay. Starting with scale, Ameriprise Financial's market capitalization stands at approximately $48.6 billion as of June 22, 2025. That firmly places it in the large cap category within the S&P 500.
Okay. And how has their revenue been growing over, say, the last 5 years?
They've shown pretty consistent and healthy top-line growth. Adjusted operating revenues expanded from about $12 billion in 2020 to over $17 billion in 2024. That represents a compound annual growth rate, or a CAGR, of approximately 9.3% over those 4 years. This growth is driven by strong client inflows, increased activity, and positive market appreciation too. It showcases the resilience of their diversified model.
What about their profit margins? Are they an efficient operation in that sense?
Their profitability metrics are quite robust, yeah. They consistently deliver strong margins. Gross margin around 53.6%, trailing 12-month operating margin of 22.5%, and a net profit margin generally in the range of 16.5% to 17.1%. Their core advice and wealth management division specifically boasts a margin of 29 to 30%. And asset management achieved an impressive 43% pre-tax adjusted operating margin in Q1 2025. These healthy margins are a clear indicator of strong pricing power and operational efficiency.
One of the most important measures of a healthy business is its ability to generate free cash flow. How does Ameriprise perform here?
They absolutely excel in free cash flow generation. They convert over 90% of their adjusted operating earnings into cash. That's huge. Cash flow from operations grew from about $4.7 billion in 2023 to $6.6 billion in 2024. It actually reached $6.84 billion for the trailing 12 months ending March 2025. This torrent of cash is what directly funds their aggressive share repurchases and those consistent dividend increases we talked about, all while still allowing for significant investment back into the business.
Looking at their financial stability, how consistent have their earnings been over the last 5 to 10 years? Has it been steady?
Their earnings growth record is definitely a standout feature. Over the past 5 years, they've delivered a compound annual growth rate in EPS of between 16% and 19%. For 2024, adjusted operating EPS grew by a remarkable 19% to $35.07. This consistent double-digit EPS growth is a clear indicator that this is a high-quality compounding machine. It's driven by that steady revenue growth, expanding margins, and the ongoing reduction in shares outstanding from the buybacks.
Okay. What about their debt levels? Their debt-to-equity ratio is around 1.1 to 1.1 fee. Now, for most companies, that might raise an eyebrow, but for a financial institution like this, is that really a concern?
It's a great question, and it really is all about context. Think of it this way. A bank's inventory, so to speak, is often money it borrows. So, unlike, say, a car manufacturer, a financial firm naturally carries more debt relative to its equity. It's just how their balance sheets are structured. For Ameriprise, with its strong, steady cash flows and high credit ratings like A from S&P and A3 from Moody's, this level of debt isn't just normal, it's considered conservative by the company itself. It appears entirely manageable. It's used effectively to amplify shareholder returns.
And what about liquidity? Does a metric like the current ratio give us any useful insight there?
For financial institutions, traditional liquidity metrics like the current ratio can often be misleading, just because of the unique nature of their assets and liabilities. Our sources actually show widely conflicting ranges for Ameriprise's current ratio, so it's probably not the best measure here. A more meaningful assessment comes from their direct disclosures. They state they maintain a strong liquidity position with over $2 billion in cash at the holding company. Plus, they hold vast amounts of highly liquid assets. This provides ample resources to meet any short-term obligations.
Got it. And that dividend we talked about earlier, just confirm, what about its stability and growth prospects?
The dividend is exceptionally well covered by earnings. That payout ratio is just 22%, providing a substantial cushion. And as we mentioned, they have that outstanding track record, increasing their dividend for at least 18 consecutive years, averaging nearly 10% annually over the last decade. This combination of robust growth and excellent coverage is truly the gold standard for dividend growth investors.
Now, let's talk about how the market actually values Ameriprise. When we look at its price to earnings, or PE ratio, what does that tell us, especially compared to its peers or its own history?
Okay. So if we look at current price of around $510, Ameriprise is trading at roughly 17.3 times its earnings over the past year, the TTM PE. This isn't excessive, really, especially for a company that's consistently growing EPS at 16–19% annually. But what's maybe even more compelling is if we look forward. Based on analyst consensus earnings estimates of around $39 per share for 2025, the stock trades at a forward PE of just 12.8.
Only 12.8 forward.
Yeah, a forward PE below 13 for a business of this quality certainly suggests it may be reasonably priced, or potentially even undervalued compared to its growth rate. In peer comparison, it sits in a reasonable middle ground, higher than Morgan Stanley but lower than Charles Schwab.
Okay, beyond these relative metrics, how do we try to determine the fundamental underlying worth of the business itself? Could you maybe walk us through the concept of a discounted cash flow, or DCF, model briefly?
Sure. A DCF analysis is a core intrinsic valuation method. It essentially answers the question, what is this business worth today, based on all the cash it's expected to generate for its owners in the future? You project out the free cash flows the company will produce over a certain period, say 5 or 10 years. Then you calculate a terminal value for all the cash flows beyond that projection period, assuming some stable long-term growth. Finally, you discount all those future cash flows back to today's dollars using a discount rate, often the weighted average cost of capital, or WACC. This gives you an estimated intrinsic value for the company's equity.
Okay, when you talk about a discount rate, or WACC, in a DCF model, what does that really mean? Especially when Ameriprise's beta is mentioned as being between 1.23 and 1.30.
That's a great question. Think of the discount rate as the hurdle rate an investor needs to clear for the investment to be worthwhile, given its risk. It's heavily influenced by how risky the company is perceived to be. Ameriprise, for example, has a beta between 1.23 and 1.30. Beta measures how much a stock's price tends to move compared to the overall market. A beta over 1, like Ameriprise's, means it's generally more volatile than the market. So a higher beta indicates higher perceived risk, and that leads to a higher discount rate. A higher discount rate means those future cash flows are worth a little less to us today. It directly impacts the valuation. The DCF output is also highly sensitive to the perpetual growth rate assumption for a mature company like Ameriprise. A reasonable rate might be between 2.5% and 3.5%, reflecting long-term GDP growth and inflation. And of course, the free cash flow projections themselves are key. For Ameriprise, these are based on their strong historical FCF generation and analyst consensus EPS growth, which is around 7–8% over the next 5 years.
So given all those factors and assumptions, what's the estimated value range from an educational DCF model for Ameriprise? What does it suggest?
Well, one publicly available model calculates a base case intrinsic value of approximately $504.02 per share, which is remarkably close to its current market price of $510.35, almost spot on.
Huh, interesting.
Yeah. A full analysis typically provides a range, though. A base case might be around $510 per share. A bull case, assuming stronger than expected growth, could potentially reach $580 per share. And a bear case, maybe incorporating risks like a recession, would be closer to $440, $460 per share. This really shows the future trajectory is quite sensitive to the broader macroeconomic environment.
Market sentiment.
So we've dissected Ameriprise's core operations, its financials, and the caliber of its leadership. That gives us a solid foundation. But a company's story isn't just about its fundamentals, right? It's also about how the market perceives it and the potential headwinds on the horizon. Let's explore that next.
Right. Wall Street's perception of Ameriprise Financial is generally constructive, but I wouldn't call it overwhelmingly bullish. The consensus rating among analysts tends to hover around a hold or moderate buy.
Okay. And what are their price targets looking like? Is there a lot of upside projected from here?
The average 12-month price target seems to be in a range of about $517 to $541. That implies pretty modest single-digit upside from the current price. However, there's a notable dispersion, a wide range in these targets. They go from a low of about $427 to a high of $642.
That's a big range.
It is. It indicates differing views among analysts on future macro impacts and how well each of Ameriprise's segments will actually perform going forward. Recent analyst actions have been mixed, but maybe lean slightly positive. Raymond James, for instance, upgraded them to strong buy back in April 2025.
What about recent news and the general media tone around the company? Any red flags popping up there?
The news flow seems broadly positive, consistently reinforcing their core strategy. Recent headlines focus on their strong Q1 2025 earnings. That was a 13% year-over-year adjusted EPS increase, beating expectations. There's also the news about their enhanced capital returns, specifically that new $4.5 billion share repurchase authorization and the 8% dividend increase. Those always get positive coverage. They're also receiving industry recognition, like being named one of America's most innovative companies by Fortune. The media consistently emphasizes the strength of their advice and wealth management division. And crucially, there are no significant negative headlines, no major regulatory investigations or scandals impacting public perception right now.
That's reassuring. Let's look at some specific market indicators now, starting with short interest. Are many investors betting against Ameriprise?
For Ameriprise, this indicator is decidedly bullish, actually. Short interest as a percentage of float is extremely low. It's reported between 1.69% to 1.86%.
That is low.
Yeah, it's significantly below the peer group average, which is over 4%. The days to cover ratio is also very manageable, around 3 to 5 days. This very low short interest clearly indicates a strong lack of conviction among bearish investors. Not many people are betting heavily against this stock.
Okay. What about its stock price relative to its moving averages? How does it look on the charts, both short and longer term? Is it trending up or down?
Well, as of mid-June 2025, the stock price is trading just above its 50-day simple moving average. This is generally considered a sign of positive momentum, a bullish short-term trend. For the longer term, the share price is hovering very close to its 200-day simple moving average. It did achieve a bullish crossover moving from below to above the 200-day MA back in mid-May. While it's currently sort of consolidating around this critical long-term trend line, a sustained move above it would confirm a solid uptrend is in place.
Ownership structure.
That gives us a good sense of the current market sentiment. Now, who actually owns Ameriprise Financial? And does that ownership structure tell us anything important about its stability or maybe its future direction?
The ownership is overwhelmingly dominated by large institutional investors. They hold a commanding 89% of outstanding shares. The top two shareholders are the Vanguard Group, holding around 13%, and BlackRock Inc., with about 9.9%. This high institutional ownership certainly lends credibility and stability to the stock. However, it's important to note that a significant portion of this comes from passive index funds rather than active investment decisions based on, deep fundamental analysis of Ameriprise itself.
Yeah, that makes sense for a big S&P 500 company. But what about insider ownership and their recent transactions? This is often seen as a key signal for investors, right? Does management have skin in the game?
This is definitely a noteworthy point here. Insider ownership at Ameriprise is exceptionally low. It's less than 1%, with most sources placing it around 0.22%.
Less than 1%. Wow.
Yeah. For value investors who really prefer management to have significant skin in the game, this could be seen as a potential concern. And adding to that, over the past 12 months, there has been a clear pattern of net selling by insiders. We're talking 51 sell transactions versus only 14 buys. Several top executives, including the CEO, the CFO, and the president of AWM, executed sales of their stock in early 2025.
So on one hand, the company is aggressively buying back its own shares, signaling confidence. But on the other hand, the very executives making those decisions are selling their personal holdings. What should we make of that disconnect? It feels a little contradictory, doesn't it?
It's a fair point to raise, and it is a critical question for investors to ponder, I think. While insider sales can often be for legitimate personal financial planning, diversification, liquidity for major purchases, exercising options, the consistent pattern of selling from multiple top executives does suggest they don't perceive the stock to be significantly undervalued at current levels, or at least not compellingly cheap. This raises the question: is the corporate buyback program primarily a tool for financial engineering to boost earnings per share? Or is it truly driven by a deep conviction that the stock is cheap? The actions of insiders, at least at these price levels, might suggest the former could be a stronger motivation.
Right. So low insider ownership combined with net selling is definitely something to keep in mind. Is the overall ownership highly concentrated among just a few big players then?
Yes, ownership is highly concentrated. The top 13 shareholders collectively control over 50% of the company, and the top 25 own nearly 60%. Now, while this means a few key fund managers could theoretically have an outsized impact, given that the largest holders are those passive index funds, their holdings are unlikely to change dramatically unless Ameriprise's weighting in major indices is altered somehow.
Risk assessment.
Okay, no analysis is complete without a thorough look at the risks involved. To give everyone the full picture, let's break down Ameriprise's strengths, weaknesses, opportunities, and threats, a classic SWOT analysis.
Sounds good. Let's start with the internal strengths. First, their dominant advice and wealth management business. It's a powerful growth engine. Second, they possess a strong brand and trusted reputation, backed by that 130-year legacy and prudent management, especially refusing the 2008 bailout. That resonates. Third, they benefit from significant scale and a diversified business model, managing that huge $1.5 trillion in assets. Fourth, they show exceptional profitability and free cash flow generation, boasting that high ROIC over 25% and converting over 90% of earnings to free cash flow. And finally, they have proven management and disciplined capital allocation with a long-tenured CEO and that remarkable track record of 18-plus consecutive years of dividend increases alongside aggressive share buybacks.
That's a powerful list of strengths, absolutely. But what about internal weaknesses? Every company has them, right?
Right, you have to look at both sides. On the weakness side, their asset management segment is underperforming. It's facing those headwinds from the broader shift towards passive investing and experiencing consistent net outflows. That's a drag. There's an over-reliance on their A&WM segment, which contributes about 65% of earnings. That creates some concentration risk if that segment hits a rough patch. The low insider ownership and recent net selling by executives create that notable disconnect with the corporate buyback strategy, which we just discussed. It raises questions. And finally, their human-centric business model is inherently vulnerable to advisor attrition, especially given the industry's looming talent shortage. Losing top advisors is a real risk.
Okay. Shifting now to external factors. What opportunities lie ahead for Ameriprise? Where could they find future growth?
The opportunities look significant, too. There's a growing demand for financial advice overall. That's driven by demographics like aging baby boomers and increasing wealth concentration directly feeding into their core business. That's a strong tailwind. They can continue leveraging technology like AI and practice tech for enhanced advisor productivity, making their human advisors even more efficient and scalable. Their strong existing client relationships offer ample potential for expansion of services and deeper engagement, more cross-selling. And, there's always the potential for regulatory easing if the political landscape shifts, which could reduce compliance burdens and costs.
What about the general external threats they face? Things coming from the market or the broader environment?
On the threat side, you have to consider. They face intense and evolving competition from literally all corners of the financial industry: banks, brokers, fintech, asset managers. There's that persistent secular fee compression in asset management, pushing down their fees in that segment continuously. Cybersecurity and data privacy risks are constant and growing concerns for any major financial institution holding sensitive client data. A breach would be devastating. And of course, market volatility and downturns directly impact their AUM-based fees. A bear market hurts their revenues significantly.
How do broad macroeconomic factors like inflation and interest rates generally affect a company like Ameriprise? Is it straightforward?
It's complex, really. High inflation can erode investment returns, which might dampen client sentiment and potentially slow asset growth. Higher interest rates, on the other hand, are generally a tailwind for their net investment income from Ameriprise Bank, as they can earn more on client cash balances.
Yeah.
However, rates that go too high or rise too fast can hurt fixed income portfolios and slow overall economic growth, which isn't good for client activity or asset values either. Ameriprise's 2025 outlook anticipates moderating growth and inflation, which is generally considered a favorable backdrop for them if it plays out that way.
And what about specific geopolitical factors? Our sources highlighted one significant concern for 2025. Can you elaborate on that?
Yeah, the most significant and immediate external threat highlighted by our sources is the newly implemented U.S. tariffs of 2025. The U.S. administration has imposed a new 10% universal tariff on most imports. Now, this policy is expected, by economists cited in the sources, to increase the consumer price index by plus 0.8% to plus 1.4%.
Okay, boosting inflation.
Right, while simultaneously reducing real GDP by an estimated 0.7% to 1.5%.
And slowing growth. That sounds like
stagflation.
Yeah.
Exactly. This combination of higher inflation and slower economic growth creates a distinct risk of stagflation, which is one of the most challenging environments for financial markets. It would directly impact Ameriprise's AUM-based revenues, client activity, and overall market sentiment. This specific tariff policy stands as arguably the single largest external threat to the company's near-term performance, based on this analysis.
conclusion.
So we've covered a tremendous amount of ground in this deep dive into Ameriprise Financial. Let's try to synthesize our findings now and wrap this up. What are the key bullish points for Ameriprise? What really stands out on the positive side?
Well, the bull case for Ameriprise really paints it as a high-quality, shareholder-friendly, value compounding machine. It has a wide and durable economic moat, built on that 130-year legacy of trust and its vast integrated network of over 10,000 financial advisors. That network is a truly difficult-to-replicate asset that fosters incredibly sticky client relationships. The business itself is exceptionally profitable, generating those world-class returns on invested capital and just a torrent of predictable free cash flow. This financial strength is amplified by a management team with a proven long-term track record, notably their prudent navigation of the 2008 financial crisis. That still matters. And for shareholders, management's commitment to returning capital through aggressive share repurchases and that rapidly growing dividend increase for over 18 consecutive years has resulted in market-crushing returns since 2005.
Okay, that's a compelling bull case. But what about the bearish points, the internal vulnerabilities and external threats that could potentially derail that impressive picture?
Right, the bear case centers on a few key things. Internal vulnerabilities like the increasing dependence on its A&WM segment, especially as its asset management division struggles with those net outflows and the industry's broader shift to passive investing. That concentration risk is real. It's compounded by the very low insider ownership and that recent pattern of net selling by top executives, which, as we discussed, creates a bit of a disconnect with the company's aggressive corporate buyback program. Makes you wonder. Externally, the company is exposed to significant macroeconomic and geopolitical risks, particularly the 2025 U.S. tariff policy, which threatens to trigger a challenging stagflationary environment. And of course, a severe market downturn always remains a key threat to their AUM-based revenues. That's just the nature of the business.
Let's bring it all back to valuation then. What does our intrinsic value analysis suggest about Ameriprise's current share price of around $510? Is it cheap? Expensive? Fair?
Our intrinsic value analysis suggests that Ameriprise Financial is currently trading in a range that really reflects its fair value. That educational discounted cash flow model indicated a base case intrinsic value of approximately $504 per share, which is almost identical to its market price on our analysis date.
So fairly valued seems to be the consensus.
Pretty much. A plausible valuation range, accounting for different economic scenarios, would place its intrinsic value maybe between $440 in a bearish recessionary scenario and perhaps $580 in a more optimistic high-growth scenario. The current price sits right in the middle of that plausible range.
So what's the concluding outlook for you, the potential investor, looking at Ameriprise right now? Is this a fortress of value that new investors should jump into today?
Ameriprise Financial is, by many measures, what Warren Buffett might call a wonderful company. It possesses a durable competitive moat, generates exceptional returns on capital, and is led by a management team with a superb track record of creating shareholder value. However, at a share price of $510.35, it appears to be trading at a fair price, not necessarily a wonderful price that offers a significant margin of safety. The current market price aligns well with our base case estimate of intrinsic value. It suggests the market has pretty efficiently priced in its strengths and its predictable growth prospects. So, for a value investor seeking a substantial discount between market price and intrinsic value, Ameriprise may not present a compelling entry point at this exact moment. It appears to be a high-quality holding for an existing long-term investor. But the considerable external threats, particularly from that U.S. tariff policy, combined with a valuation that offers little obvious discount, probably warrant a more neutral outlook for initiating a brand-new position right now.
This deep dive leaves us with a provocative question for you, the listener. In today's market, which matters more for a high-quality company, its undeniable strengths, or the price you actually pay for them, especially when these global uncertainties loom large? Definitely something to mull over. This deep dive was brought to you by Stock Analytics AI. For priority deep dives on tickers, be sure to like and subscribe to the Stock Analytics AI YouTube channel. Our 4.99-month members get exclusive access to our coverage of all S&P 500 stocks over the next few months. Don't miss out on that.
And please remember, this analysis was generated by an AI system purely for educational purposes and should absolutely not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.